welcome to the Growth Engine Fundamentals video series. And in this episode, we're going to be speaking all about finance. Now, if you think about finance, it's in every aspect of your business, and without it, your business doesn't run. See it very much like the blood that runs through the veins. I'm often asked, what role does the management team play and what role does the finance play, and a whole host of other questions. And ultimately, here's a great little way and a little sort of analogy that I like to think about it. Whilst the management team is the heartbeat of the business, finance is the blood that runs through the veins. And in this sort of video series, we're going to be speaking in each stage about the growth engine fundamentals, just to set the stage exactly what we mean, and ultimately that really falls back into two things that are very closely related, which are team alignment and making sure that right from the top, the business adopts the inbound methodology throughout the entire business model, not just the marketing area. And we'll then move into the overview of growth engine finance, and we're going to be touching on raising capital, employing capital, managing capital, and distributing capital. And the term capital is finance or money employed, and we'll talk about that. So that could equally say raising finance, employing finance, managing finance, and distributing finance. But for this video series, we're going to be calling it capital. So without further ado, let's move forward. And I said we'd start by sort of setting what I call the fundamentals. And when you're talking about growth engines, and especially around the inbound methodology, we use the inbound flywheel, which is broken up into three specific areas of attract, engage, and delight. And it puts the client at the center of everything that you do. So if you're going to become an inbound business, then the client has to be at the center of everything you do. And don't fall into the trap that thinking that the attract phase is just related to marketing, and the engage phase is where your sales team take over, and then the delight phase is where your customer service team manage and look after them, the clients once they've become customers and purchase. That's not true. The attract, engage, and delight phase is at every single point. So that applies in marketing, it applies in sales, it applies in customer service. So when we talk about growth engine fundamentals, we're going to be making references to the flywheel and ensuring that the client's at the center of everything that we do. Now, it doesn't really matter what type of business that you are. They're really outside of what I call corporate governance and the law and the legislation. So outside of that, which I've left out of this presentation here, that there is only 5 segments or areas of a business. And that doesn't matter if you're online e-commerce, you're in elongated long sale, complicated sales process, you're in B2B, B2C, H to H, doesn't really matter. The 5 really are applicable, and whatever you do within your business is really going to fall into one of these 5 buckets. So let's just take a recap of these. The 5 buckets or 5 areas are finance, operations, people, marketing, and sales. So, you might be sat there thinking, well, where does my manufacturing team or my customer service team fit? Or, my customer service team who are maybe on refunds, or, the ones who are out there doing trade shows and, and things like that. So I'll cover that on the next slide. But I just really wanted to recap. Growth engine fundamentals put the client at the center of everything that you do. And, even when they're just becoming prospects before they're even clients, that attract, engage, delight is applicable throughout the marketing, the sales, the customer service, and every single touch point that you have. So moving this next slide forward, you can see here at the bottom, finance, operations, and people really span out into what we call inbound client services. The marketing is inbound marketing and the sales is inbound sales. And I just really want to break down the point that I touched on earlier. If you think about it, the finance is what funds and fuels the business. The people is what, make it move, the actual execution of it. And that will sort of spread, people will spread into finance, like your purchase ledger clerk, your finance directors. People spread into marketing, marketeers, and obviously salespeople, business development reps, sales managers, field representation, whatever you have type of titles there. But people always drop into operations. And the way I see operations is everything from the products that you manufacture, the distribution channels that you get your goods to market, whether that's your transport division, your courier division, your customer service team, your research and development team. So that's really where I bundle operations in. And ultimately, if you think about it from a inbound marketing point of view, that's bringing prospects who eventually become customers through inbound sales. And then inbound client services is really the fulfillment or the production or delivering what you've sold. So again, it's just getting familiar with that terminology, right out of the gate. And ultimately, if you think about it from that point of view, if it's not marketing to bring people to the business and nurture and educate them through the process, or it's not sales that is actually, engaging and helping people to buy, then ultimately it's going to fall into fulfillment that we class as inbound client services. So let's get, a little bit of more of a highline overview on growth engine fundamentals of finance. But that really moves us forward and then into distributing capital. Now, distributing capital, we are going to be talking more about capital gains, i.e. profits. If you think about the journey, we've raised or invested capital, we've then employed that to best use. We've then managed that, and if we've done a good job, it's more than just finger in the air and a bit of luck. And ultimately, the market has been kind to us. Our strategy was sound. Our management was true, and we should be talking about profit at the end of the day. So I am going to cover profits post-tax. You will see abbreviations, EBITDA, earnings before interest, tax, depreciation, and amortization. But I'm actually talking, about the bottom line. Any depreciation has been taken off, any tax has been taken off, and ultimately, we're talking about the profit, the true profit, and the gains that we've made, whether that be in a month or in a quarter or a year. I'm going to talk yearly here, just because it allows me to have a broader section than just talking what profit we made today or this week or this month. If you consistently do that over a year, this is what this is relating to. So there is shareholders distribution. So at the end of the year, you've made, let's say, £500,000 or £100,000, £50,000. And then the shareholders, they can say, okay, we're going to award a dividend. And you may have heard that terminology around, and that depends on how many shares or what percentage and what dividend per share that you're going to give, and that's a bit of an additional reward. That's not tax-free, so even though we are talking profits post-tax, that's post-tax from a corporation tax point of view, any dividends that you pay yourself are going to need to be taxed through your tax return or whatever it would be. So you would have to pay additional tax. So it depends whether you're in lower or higher thresholds, and that percentage will apply. And again, if you're unsure about what tax liability you're going to need to pay on dividends, and then ultimately you can have a chat with your auditor or your bookkeeper, your accountant, etc. And there's different rules around national insurance and corporate and personal taxation as well on dividends. And again, they'll be better suited to advise you at a deeper level. What I would recommend is not for directors not to take everything out. If you stand still, you actually go backwards. Think about that your business people, your staff are going to need pay rises. The cost of buying goods is no doubt going to increase. The fuel cost of taking product to market, the delivery couriers or your own transport fleet, that goes up. Just the general cost of living and the general operating cost of a business can be 3-5-8% more than they were last year, depending on the type of model. So don't think, oh yeah, we've made £100,000 taking all that. There is other things that you can use, and I would highly recommend you have a split ratio to distribute the capital and the profits that we're talking about. One is to dividends and to reward the shareholders, but reinvesting into R&D. We talked about that earlier when we were talking about employing capital. reinvesting in, how could we make our products and services better? How could we do that? So I would certainly have a budget to reinvest back into R&D and keep that constant. You may want to use capital to buy a business. Maybe you've got a competitor who are weak in the market. Maybe you've outperformed them. They're a little bit nervous in the market. They're losing customers, they're losing staff, they're migrating over to you or another competitor. And there may be just a good fit where you can go and buy a company. Maybe they've got a better manufacturing plant than you. Maybe they've got a better sales team than you. Maybe they've got a better marketing team. Maybe they've got a USP that you can't manage to create with, and that may be weak and that you could acquire them for a lower value. So acquiring another business or merging with another business and using capital to distribute into acquisition, a great way to grow and build on the baseline to really attack the market. New verticals or market entrances, depends on what you're talking about here. If you've got cash and profit, you could keep doing what you're doing and keep doing that, of course, and tweaking it and reinvesting into R&D and making your market better and stronger. But ultimately, you may want to say, hey, I'm in this particular business, like I'm in the garage, I sell cars for a living, and hey, we want to open a service center, because there's a natural fit there. It complements the existing sale. You might want to go into something totally different. And if you look about us at The Successor, we don't want to just build growth engines. We have an executive coaching and non-exec side business that was really our original business. The new verticals, the market entrance was really bringing in the inbound agency to get our customers stuff to market. But a new vertical that we're in is growth, venture capital, and raising venture funds for businesses. And shaping and modeling their business to introduce to venture capitalists. And we have a brand called Growth Engine Ventures that does that. So that's like a new vertical. A lot of our clients are either already raised capital or wanting to raise capital or the next round of capital. So it makes sense for us to be in that venture capital sort of early stage angel investment venture capital market. So that might be a new vertical that you want to open because it complements. So think about how you can distribute your capital. If you've got cash, you can make more money with cash. You might distribute it and not even put it into a high, long-term savings fund or, the stock market or something like that. You might even invest it into a pre-IPO if you're at that stage. You've got growth capital in your business and you want to go through into IPO, initial public offering to float your business. You might want to distribute it into sort of driving that forward because that's going to, create a bigger return on investment. So have a look at it. If you've got any questions about the best way to distribute your capital, again, use the hashtag Growth Engine on Twitter, leave a comment below on the blog, or if you want to connect with me on LinkedIn, I'll be more than happy to have a discussion with you and see if I can give you some advice. So as we move forward, if you're interested in what we do more about growth engines, and whether that's about finance, operations, people, marketing, sales, or even corporate governance, if you want to set up an initial 15-minute consultation, let's just see if there's a fit. There's no sales pitch from us. One of our growth engine inbound pros is going to sit down and they're really looking at three things. Where you are as a business. They're going to learn about your business. They're going to see if we're really a good fit and you've got problems or challenges or pain points or aspirations that we can help with. The worst thing, if you come off the call, you'll have had some free sort of tips. And then if that's something that works well, we can set up some further 45-minute sort of what we call discovery calls and meetings to sort of really dig deep in there. But if you want to take advantage of that, literally click the Let's Talk button on this page, or you can head over to any pages on www.thesuccessor.io for everything in detail about growth engines and what we do from there. So that wraps up our growth engine fundamentals on finance. As I say, to wrap, if you want to shoot over to Twitter and use the hashtag growth engine, ask us any questions, we'll get those answered for you. Alternatively, leave us a comment below on the blog. If you're watching this on the YouTube channel and want to know what the blog address is, it's blog.thesuccessor.io. So that's blog.thesuccessor.io. You can head over there. And as always, to get in the game, go do the hustle, go make it happen, and we'll catch up with you on a growth engine fundamental overview video series real soon.